Chile in crisis. Protests erupt in the country. Workers go on strike, sending copper prices higher. In defense of shale, city says shale is once again under attack and that the naysayers will be proven wrong. And Dwight Anderson's top calls. Famed investor gives his best commodity picks: sugar, a relative value wheat play, and maybe natural gas. I'm Alix Steele. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On. It's our reporter and analyst take on our big story, and the spotlight is on Chile. Copper workers joined anti-government protests after violence erupted last weekend. Mine production is now halted at BHP's Spence mine, while other operators like Freeport are running at limited capacity. Joining me now is Bloomberg's Laura Milan in Santiago. Laura, can you give us a sense of the scope of what's happening on the ground?
Yes, good afternoon, Alix. As you were saying, BHP's Spence mine is completely halted right now. We also have other mines, specifically by Antofagasta PLC. So one of their mines, Pelambres, that's their biggest operation, it's been halted since Monday after local communities stormed into the mine and burned some of the installation. So that's 4 days of stoppage at their largest mine. And then, as you were saying, there are other mines in the country that are holding 24 hours, 48-hour stoppages as workers join the protests that are happening across Chile, anti-government protests.
How long do we expect this to last for?
So we don't really know. Most of the protests and most of the strikes, unions are saying they will go on for 24 hours. But then what they're all saying as well is that they want to see some answer from the government. They want to see some action. They want to see the demands of the people listened to, answered to. And if that doesn't happen, they will talk about and they will plan more actions, more mobilizations.
All right, thank you so much for joining us. Bloomberg's Laura Milan joining us from Santiago with an update on those protests. So that's the news. Now we want to get to the trade of that. Chile is the largest copper-producing country in the world. So for more on what that means, we're joined by Bank of America Merrill Lynch Head of Metals Trading, Michael WIDMER. He joins us on the phone from Paris. Michael, what does this actually mean for the copper price short term in terms of volatility and the absolute level?
Look, I think, as you said, Chile is the biggest copper producer, producing around a third of global copper production. I think we have lost a lot of copper supply already this year. Actually, we are down in terms of copper mine supply. So really, it depends on how long those disruptions last. I think the longer they last, the bigger the impact will ultimately be. I think Chile is just too big a market participant to disregard any unrest completely, I think.
In terms of how tight the market may actually be already, I have a chart for you that shows canceled warrants on the LME. So basically, if you're taking physical delivery, that means you give a canceled warrant. That's actually been rising as a percentage of overall inventory. It's about 45%. Is that real demand, and is the market super tight, or are we looking at sort of moving inventories around the globe?
Yeah, look, I think warrants are not necessarily the best indicator, I think, for fundamentals. But when you're looking at mine supply, actually, there is a set of indicators called treatment and refining charges, and they have actually been falling for quite a while now, and they do suggest that at least mine supply is actually quite tight. Pity though, because global demand is just too weak to make a difference. I think if demand was just a little bit stronger, I think copper prices would potentially be much higher compared to where they are right now.
Well, where is the incremental demand going to come from?
And that is exactly the issue that we have right now. At the moment, is unfortunately not coming from anywhere. China is still relatively subdued. The U.S. economy is slowing, and Europe is basically not growing. And that is the underlying issue that you have, I think. From the supply side, the copper market does actually look quite good. If those three regions were accelerating, I think you would have a decent chance, I think, for copper prices to rally. I actually think copper is the proxy trade on all of the macroeconomic issues that we are facing at the moment, and those are effectively what is holding copper prices back. Again, reinforcing the supply side is actually very supportive to copper prices at the moment.
So it really reminds me also of what we see in the oil market is that you have these macro headwinds that tend to weigh, say, on the spot price and even lower out down the curve. But then you have these geopolitical risks that come in that should send the spot price higher, but it doesn't really happen. What should the price be? Are we at the right value for copper?
And I think the price where it is right now is actually from a spot market perspective, and where demand is fair value. I think when you're looking at the price that you need for the mining industry to actually invest in new mines, we are at least 15% below that level, and that means longer term you're probably not having the supply growth that you need to keep copper mine supply increasing on a sustainable basis.
All right, Michael, thank you so much for joining us. Michael WIDMER of Bank of America Merrill Lynch. And this ain't no hogwash here. America's sitting on a mountain of uneaten bacon. That's more than 40 million pounds of pork bellies were sitting in refrigerated warehouses as of September 30th. That's the most for the month since '71. Hog producers started building up their herds in anticipation of more demand from China, where the African swine fevers killed millions of pigs. Seriously, talk about some bacon. This is Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for the data dig, where we delve deep into the market trends. So first up, those oil inventory numbers, pretty much bullish across the board. This is combined distillate, gasoline, and oil inventories. If you count all the products, we drew about 10 million barrels, a huge draw. We exported more, imported less, plus refiners came back from maintenance. And talk about a price pop. Take a look what happened to soybeans. So the bottom panel here shows the jump in prices. China could buy as much as $20 billion worth of ag products a year. That's helping the prices. And then here at the top, you see net holdings were the most bullish right now in the market since June 2018. And if you're in California, be prepared for more darkness here. More than 500,000 people without power in the state. You have PG&E and other utilities like Edison and Sempra. Here's their intraday chart over the last 5 days here. At the same time, you also had a fire that already started in Sonoma County. So this is going to be a recurring theme, particularly during fire season. All right, now we want to get into the ring. It's commodities versus the upcoming presidential elections in Argentina. Citizens take to the polls Sunday to choose between Peronist Alberto Fernandez and Mauricio Macri, who was pummeled in the August primaries. I'm joined now by David Towell, president of Magdalena Capital, which is an event-driven hedge fund and is the largest shareholder of Magdalena Energy, which holds 4 oil properties in 4 provinces in Argentina, including the shale region Vaca Muerta. Also joining us from Houston is Harrison Williams, managing principal at Core Energy Advisors. Welcome, gentlemen. Good to see you. So, David, what's the company bracing for? What's the strategy come Monday morning?
So I think everybody is anticipating a repeat of the primaries, where we'll have Fernandez win by a large enough margin to go ahead and declare him finally president. So there won't be a runoff in late November. I think that's what the market is anticipating. I think that's what polls are showing. I think the energy market is extremely anxious to hear what the energy policy is going to be going forward. Alix, it's really important to understand that Argentina holds the 2nd largest natural gas shale deposit in the world and the 4th largest oil shale deposit in the world. It is currently being explored. It is currently being produced. Many majors from around the world are down there, and it is the most important sector for the Argentine economy. Over 50% of investment in Argentina over the last 4 years has been dedicated to the energy sector. And clearly, it can help the company's fortunes going forward. It's just a question of how does the government, with its troubles financially, go ahead and incentivize drillers financially to drill. What would it take for drillers to start drilling again? We have an oil price freeze. That's one thing. You also continue to have an export on oil products and oil to begin with. So what's it going to take for Magdalena, for example, to go in and do it? Well, Magdalena is actually drilling as we speak. They haven't pulled back at all in light of the freeze. Okay. Yes, their properties are in such full swing, so to say, that it's going ahead. It drills with Pan American Energy, which is an arm or an investment by British Petroleum, and they are going ahead and drilling, and production is uptick. But to your point more broadly, I think it's going to take a clear energy policy and a clear path towards profitability for the majors. I don't think that the country is going to have difficulty doing that. I think it's going to have difficulty in the short term balancing, obviously, the high price relative on a peso basis, the price of gasoline at the pump or the price of electricity in the home vis-a-vis natural gas. But on the other hand, it seems clear to me for the long term, and I think it seems clear to almost any economist in the country that you talk to, that in order to go ahead and increase the good fortunes financially of the country, the energy sector is going to need to succeed. The only way the energy sector succeeds is if it is incentivized to go ahead and invest in the country to produce more oil and natural gas.
So, Harrison, you advise companies. They're going to come to you and say, hey, I want to get into shale. I don't want to get it here in the U.S. Maybe I go to Argentina. What do you say?
I say you better be a pretty healthy, large player to expose yourself to that kind of political risk. And it's just a tough thing. I agree with David. There's a difference in short-term and long-term. But I'm sometimes at my age reminded that John Maynard Keynes says, in the long run, we're all dead.
That's pretty bleak. So does that mean that there's like nothing that you think? So let's take what David was talking about in terms of this is a very important asset. The policies at some point will come into place. It's just a matter of kind of how quickly. Do you not believe that? Or do you think it's going to be a lot slower than maybe some people think?
I absolutely believe he's correct in that. And this is the way out of the financial mess in which Argentina finds itself, again. However, killing the golden goose is something that Argentina has historically been very good at.
So does that mean if I'm a company and I come to you, you want to tell me to go to U.S. shale instead, for example, or is that not a good bet either?
I think U.S. shale is a much more certain bet than Argentina. But again, if you're a very large company and have that kind of opportunity, you need to be exposing yourself to opportunities in lots of places. And so Argentina is a great place to do that on a technical basis.
Mm-hmm. So, David, what do you feel like is the right kind of capital that need to come in? Like all the majors are already in there, like as David was just, that Harrison was just talking about. Is it enough? Like how much more do you see to scale up? So
for sure, to your point earlier about the price freeze, right? A lot of majors have scaled back their drilling in the past quarter based on that. They need to know, based for purposes of their own projections, what exactly the policy is going to look like in order to continue to invest. And certainly there have been pronouncements, even by Vista Oil and Gas CEO yesterday on their earnings call said, we're ready, willing, and able to invest more money in Argentina as soon as it becomes clear to us what the path forward looks like. So I do think that it is increased investments by those that are already there. More importantly, Alex, there are lots and lots of global players that are not yet invested in Argentina. The Russians, the Chinese, much of the Nordic players as well. Eventually, they will want to go ahead and invest there too. Do I expect that there will be foreign financial investors that will come running to Argentina? I don't expect that to happen in the near term, maybe in the medium term. I expect mostly strategic players will continue to invest, and those that are not yet there are going to invest going forward.
So Harrison, in the meantime, though, there's going to be consolidation here in the U.S. in terms of shale, where it's going to be the big players that are probably going to come in and buy the smaller companies. There was an article in the Journal over the weekend that talked about like a new type of bond that basically you own part of a well and its production, and that was the bond that you were going to get. Is that a good investment? Like, how do you look at these new debt financings?
If underwritten correctly, and there's a lot that goes into that, this could provide yield, which is currently lacking in a lot of the financial products that you can buy. So the theoretical ability for oil and gas production to give you a yield is high, but you have to do the underwriting correctly, which requires good reservoir engineering, good hedging, good wells, lots of stuff. Devil's in the details.
Harrison, is funding drying up? Is it dried up, or is it still open for U.S. shale players?
What funding? It is absolutely dried up. The equities have been absolutely punished. The global uncertainty hurts. It's everyone, the industry is in effect probably over levered quite a bit. So everyone's being told to live within cash flow, that's difficult in many cases.
All right, guys, thanks very much. Great conversation. David Tawil, president of Magdalen Capital, and Harrison Williams at Core Energy Advisors. All right, time now for our note of the week. Let's stay with U.S. shale, and it's a twofer. You got banks coming to the defense of that industry. So Goldman Sachs says we still expect shale output to grow both in the fourth quarter and next year. Production is still rising into year-end as new pipelines become available. Meanwhile, Citi also had a quote saying that once again, U.S. shale is under attack, damping the output outlook, but once again, it looks more resilient than many think, and they caution against overly bearish projections. All right, coming up on this program, Dwight Anderson, the CEO of Osprey, talks about his company's battle plans when it comes to commodities and crops. Next on Bloomberg Commodities Edge. I'm Alix Steele, and this is Bloomberg Commodities Edge. It's time now for the BNEF Brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. At a Bloomberg NEF summit this week, executives debated the future of batteries for energy storage, worried about their weak investment case and lack of government support. Joining me now for more is Logan Goldie Scott from Bloomberg NEF. Logan, what did we learn at the summit about batteries for storage?
I think the biggest thing that we learned was that investors and developers in Europe are still struggling with the small scale of the industry. Last year, 160 gigawatts of wind and solar was installed globally, compared to only 4 gigawatts of energy storage. And so they're not used to this scale of market, and they're struggling to understand how it will grow. What we expect to see, though, is entering a new phase of renewable energy deployment, which pairs low-cost wind and solar energy with low-cost energy storage. And as a result of that, we see batteries, total installed batteries by 2040 hitting over 1,000 gigawatts of installed capacity.
Well, but aren't prices coming down in terms of cost for energy storage? I mean, I thought lithium prices were off 84% this year. So what gives?
Exactly. So this really is an issue of scale, but we see this, we're at a turning point at the moment. There are two things which are driving this sort of increased uptake that we expect in the future. The first, as you've mentioned, is falling costs. A recent Bloomberg NEF survey, we predict that fully installed system costs will halve over the next decade. And secondly, is decarbonization, where as you retire thermal power plants and you replace them with renewables, you need energy storage as a source of flexibility. So this is the change that we see coming up.
All right, Logan, thank you very much. Logan Goldie Scott of Bloomberg NEF. All right, time now for Commodity in Chief. We're going to talk to one executive in the commodity world, and today it's legendary investor Dwight Anderson, head of Osprey Management, a $1 billion firm. It has 25 funds, including commodity, equity, macro, and private equity strategies. I recently caught up with Dwight and asked him for some top trades.
Majority of our risk is focused right now in the soft markets, where predominantly within coffee and sugar, both are moving into structural deficits. You still have material inventories from the past couple of years of surpluses, but at these low prices, which are unsustainable for the industry, at the aggregate short positions, they're markets that we think are really compelling longs.
When do you think the view turns in the market?
I think in terms of both of them, but probably sugar, probably more imminently, just because you're coming out of the harvest in Brazil. You just had really the peak of the weight of the inventory going into September. And so the near-term move is probably more probable in sugar.
What about softs here in the U.S., like corn, soy? I feel like all of them so related to trade. Where's the really good opportunity?
Sure. In terms of grains, at the moment, in terms of flat price, we don't have strong conviction. Is the only way we view that there's upside, again, is a single variable. It comes down to China. But there's some interesting in that the hard wheat, which is the Kansas City contract, is trading at an almost dollar discount to soft due to some changes in that contract and some quality issues with soft. But we think that's unsustainable. And so if you look at the March contract at a 90-cent discount, something like long Kansas City versus Chicago is also, I think, an asymmetric bet.
Do you play the trade headlines when it comes to grains at all? How do you look at it?
We tried in the spring, around March and the May contracts, at times having some long option positions to take advantage of that. But as the trade deals got pushed out, those expired worthless.
But we talked about palladium, right? Didn't you have a potentially bullish view on
palladium is at record prices, at record spreads to platinum, and yet it's still, even from here, is potentially explosive. So you're looking at a just under $1,800 commodity that might need to trade $3,000 to destroy demand, and rhodium $10,000 as well, because the two are tied into the auto catalyst market. You're in a deficit, especially as China brings in their emission standards. You ramp up demand there. That we don't see any way that you can solve the balance sheet hole except through destroying demand, and that can only happen with high prices.
So why wouldn't you go long palladium now? Are you waiting for some kind of pullback? Like, do you think it'll be more volatile?
One of the things that we struggle with is we have a modest position in palladium, modest to the point of almost de minimis, and it's in options. You are at record prices, just in absolute terms, and so there's no economic difference between $1,800 palladium and $1,200. It's record price. You're incenting, sort of as much supply and relative switching as you can at that, barring a destructive price. So it's while we believe most likely could double from here, this is something that will be incredibly volatile and choppy.
Are there trades that you want to put on in commodities that you haven't yet, that you're really sort of looking at the right entry point, or you have a thesis on that you're looking at?
We believe that 2021 natural gas is actually starting to look interesting. We think it's too early with the amount of production growth that you still have, and with the unknown variable still in terms of the winter. And so people also have been taught to not price in any instant risk returns forward into natural gas. And so unless you have the 20% probability of a much colder than normal winter, that won't move yet. Okay? But that's something that, relative to how supply is shaping up, delays in certain pipelines like the Kinder Morgan Permian Highway just was delayed, the demand growth, some of the fall off in terms of the interior shale drilling, I think you're setting up where natural gas forward for 21 is starting to get interesting.
That was part of my interview with Dwight Anderson of Osprey. They're up 13% year to date in September. All right, coming soon to a produce aisle near you, a new variety of apple that's whipped up a lot of frenzy among fruit lovers and growers alike. It's called the Cosmic Crisp. It was bred by Washington State University over the past 2 decades, and it's named for the bright yellow dots on its skin, which are said to resemble stars. The much anticipated apple's a cross between the Enterprise and the Honey Crisp, the former known for its durability, the latter for its flavor. The result, one massively marketed piece of fruit. The ad blitz behind the Cosmic Crisp could be over $10.5 million. Growers have actually planted 12 million Cosmic Crisp trees. The only question, will consumers get the bite? And here's what's on my commodity radar for next week. So Sunday, you have the Argentinian elections, so stay tuned on Monday for that. Then Monday, you also have LME week kicking off in London. And on Tuesday, it's Davos in the desert. And Friday, you have earnings from Exxon and Chevron. So we have a very busy week with numbers as well as macro. That does it for Bloomberg Commodities Edge. Make sure to catch us each Thursday at 1 p.m. New York time. This is Bloomberg.